My name is Christine Shao, and I am from KW Executive. On behalf of the Education Committee of the West San Gabriel Valley of Realtors, we would like to welcome you to today's Zoom and Learn about how to protect your wealth to keep more of what's yours. And before we begin, please remain muted during the presentation and feel free to type in your questions into the chat box. We'll have Jonathan introduce us to our wonderful guest speaker today. Please take it away, Jonathan.
Thank you, Christine. Good day to everybody. My name is Jonathan from First Team Real Estate in Diamond Bar. Like Christine said, I welcome you to the presentation from Education Committee, How to Protect the Wealth and Keep More of What's Yours. Anyway, I'd like to introduce Tony. Our guest speaker for today is Tony Watson from Robert Hall & Associate. I have attended multiple presentations hosted by Tony via different venue, including Western Valley Association of Realtor. Let me tell you that I do learn a lot from this man though. Surely that can benefit myself and also benefit all my clientele as well. So here is a little brief introduction of Tony. Waiho federal license as enrolled agent tax practitioner and personally managed over 350 million in real estate holding. Also, Tony is also an active real estate investor, entrepreneur, and enjoys short and long-term trading. With his decade of experience, he's well qualified to advise, represent, and prepare tax return for individual, partnership, corporation, and any other entity with tax reporting requirement. And he's also actively looking for the newest and most up-to-date strategy to implement on client tax filing. Without further ado, let me give a warm welcome to our speaker, Tony. Tony, I'm passing the baton to you, though. I think, Tony, you have to unmute yourself.
Yeah, I had to find the button really quickly here. All right, and everybody can see my screen? Hopefully they can. All right. Thank you so much for having me. It's always a joy to come back and speak for the association and share all of the information that I have with everybody who's willing to log in and listen to the wonderful world of taxation and how you can implement certain strategies to keep more of what's yours. When I first started working for Robert Hall & Associates 17 years, actually a little bit over 17 years ago now, one thing that I remember Bob Hall telling me, because I was his right-hand man for the first two to 3 years that I worked here, is that it's not about how much you make, and it's really not about how much you spend. It's about, at the end of the day, how much you get to keep. And utilizing certain parts of the Internal Revenue Code to help shelter your income will help you grow your wealth exponentially. Everybody's heard of the famous phrase, life, death, and taxes, meaning that while you're alive, the government's going to want their fair share, what they consider to be their fair share of tax revenue. And even after you're long gone, they will continue to follow you, while you're 6 feet underground and try to still capture or collect money from your estate. So it's really important as you move throughout each calendar year to strategize with your tax advisor and figure out creative ways to acquire assets and shelter the income that those assets are generating for you. As well as to build on that, right? It's not about just buying a property and letting it cash flow. It's that's important, obviously, but it's about buying a property, utilizing the bank's money to capitalize on that investment and catapult it into acquiring more real estate investments. That's the number one asset I find to be the most consistent revenue generating asset amongst my 1% clients and amongst the wealthy of the world. That should tell us all something, right? My whole goal is to copy and paste what works for my clients who are 1%er filers, individuals who are making net over $500,000 a year in taxable revenue, and just to copy and paste what they're doing. Because let's face it, if it's working for them, why wouldn't it work for us? So today's topic, very near and dear to my heart, how to protect your wealth and keep more of what's yours, because at the end of the day, it is yours. And the government will want their fair share at the end of the year, but there are creative ways to utilize the tax code to our benefit to keep more in our own pockets. Thank you for the introduction. I am a real estate investor. I'm a small business owner. I am also a day trader, and the past couple of weeks have been pretty rough in the market. But once again, with these rough waters, with these rough tides that we've been seeing in the market, there will be created opportunity for us moving forward. I have a lot of clients calling, asking if they should sell out of their assets. And I am a true believer that until you sell, you really haven't lost anything, right? It's a little difficult to log in and check your brokerage accounts on a daily basis these days, but the US economy does its ebb and flow, and there's a lot going on in the world, especially coming out of our very unique pandemic years, but there will be opportunity on the horizon. As interest rates continue to increase, I still truly believe that real estate is the most secure asset we can park our money in. Let's face it, as the world turns and as the economy ebbs and flows, one thing is for certain, that whether the economy is good or bad, people will always need a place to live. And why not live in one of my rental properties? Why not live in one of our rental properties, right? So just keep that in mind, that real estate is one of the most consistent appreciating assets you can park your money in. Someone else is paying down the debt for you in the real estate rental world, investment world. And whether the economy is good or bad, people will always need a roof over their heads. So keep that in mind. I've been working for Robert Hall, like I mentioned, for over 17 years now. My personal clientele, just, roughly, I think this number has actually increased, should be well over the $400 to $450 million marker now. So here at Robert Hall, we see a lot of 1031 exchanges, a lot of cost segregation analysis filings, a lot of elections to change accounting methods, mark-to-market elections for day traders. We see a lot here at Robert Hall, and we service just above about 10,000 tax filings per year, and we file tax returns in all 50 states. I myself, I think I now have clients actually filing returns in all 50 states. I'm not going to pretend to be an expert in each individual state, but if there's anything that I don't know about, or if there's anything that our staff doesn't know about in other states or other parts of the US, we are very much a research firm as well. We will find those answers for you. So keep that in mind. I am by no means a one-man operation. I have a wonderful staff here at Robert Hall. Like every industry across the board during the pandemic, we went through our own trials and tribulations, but we have been able to rehire a lot of the employees that we had lost during the pandemic. So we have well over 50 employees now back at Robert Hall and Associates. And a number of senior advisors here at Robert Hall that are open and readily available to help and assist with any questions that you have, and as well as any tax filings that you have to file for current year and past years. Sometimes clients call us up and say, hey, listen, is there anything I can do to correct a previous year's return? And there are some things coming out of the pandemic years as part of the CARES Act that allow us to carry back certain deductions or even amend previous tax return years to create a refund scenario, getting back some of the money that you've paid in past years. So if that has been a question of yours, we do offer free consultations, which I'll mention in a couple slides here. We'd love to hop on the phone and analyze 2018, 19, and 20's tax returns for you, even 2021's. I'm sure the 2021's filings were correct, but we can advise on past year's filings as well and figure out if there's any money that was left on the table that we could potentially get back for you. It's not just about preparing for 2022 anymore. It's about taking a look at the past returns that were filed as well and figuring out if there's any corrections that need to be made there. So keep that in mind. We are a pretty sizable firm. Like I mentioned, we service just around 10,000 plus tax filings per year. We've been around since 1971. So I'm sure for those of you who have heard me speak before, you know about Robert Hall and Associates. And as a firm, I think that with all of our clientele and the 10,000 tax filings that we file each year, I think we're well over the $1 billion marker in overall real estate transactions reported on returns, properties under management, so on and so forth. We don't only work with real estate professionals, we work with all industries. And any individual who files a federal, individual, corporate, LLC, partnership, estate, trust, nonprofit return with the federal government and the state agencies. So we are well versed in the internal revenue code across all industries. So once again, keep that in mind. Aside from tax preparation, we do offer estate planning, internal auditing, payroll services, incorporating services. So we're kind of a one-stop shop for all of your financial needs. And like I mentioned, we do offer free consultations, and I'll remind you about this towards the end of today's presentation as well. You can take a picture of the screen that you're looking at right now, or use your smartphone or smart, tablet and open up the camera application and scan the QR code at the bottom right part of the screen. That will automatically prompt you to click a link that will allow you to sign up for the free consultation. So keep that in mind. A number of things to cover today, but one thing right out the gate is the power of incorporating. I get this question a lot. Is right now the right time to incorporate my real estate investment portfolio, maybe set up some LLCs to create greater limited liability protection for these assets? Is it going to save me any tax by doing so? Or questions from real estate professionals. Should I take my self-employed real estate commission income and incorporate it into a subchapter S corporation? What about the C corporation? Do I need a C corporation to shelter my assets? If I have foreign investors coming in with money outside of the US, which entity is better to collect this foreign investment income? These are great questions, and they're very commonly asked questions. And I want to make sure that we kind of break down some misconceptions of incorporating right out the gate here, because incorporating is not right for everyone. I want to make sure that everybody understands that incorporating is not going to be right for all of you. And so when we take in these new client consultations, I personally, and as well as my senior advisors here at Robert Hall, we call it the interview process. We need to interview our clients to make sure that incorporating is right for them specifically. Just because a coworker or a family member or a friend incorporated themselves and they see a great benefit by incorporating doesn't necessarily mean that you're going to receive the same benefit. We need to interview our clients to make sure that it is the right choice for them, that it's going to be a consistent benefit for them year over year moving forward. And in this interview process, there are three main questions that we need answers to. And number one is, what personal assets do you own that need protection separately from your business assets? Do you own personal retirement accounts? Do you own a primary residence? Do you own any assets that you've inherited over the past 2, 3, 4, 5, 10 plus years? What assets do you own personally under your primary social security number that we need to separate from all of your business assets? The reason why that is the most important question during the interview process is because incorporating, sure, it might give you some other income tax benefits and some sheltering benefits, but the number one benefit of incorporating is asset protection. It is the benefit of separating personal from business assets. Now, the second question, if you say, yes, I do have personal assets, I do have things that need protection separately from my business investments and my self-employed revenue streams. Okay, so we check yes to that first question. Number two would be, what is the consistency of your net profit? What level of income are you sitting at? Are you at 30 grand consistently per year in net profit? Are you at 100 grand or 500 grand? We need to make sure that by incorporating, we are going to not only be receiving the asset protection benefit, but that we're also going to see some sort of income tax benefit under certain types of entities, which we'll get into in a couple seconds here. So question two is, do you even have the cash flow that meets the qualifications or the requirements to take that next step to incorporate? Let's say you say, yes, I am making 100, 200, 300 plus grand in net profit. So yes, we check yes to question two. Question three normally isn't as important as question one and question two, but we throw it in there just to cover all bases. What kind of risk and liability do you operate at within your industry? I know that real estate professionals, I know that physicians, I know that legal advisors and financial advisors and accountants, we all have our own level of risk and liability in what we do, but each industry carries its own separate levels of risk and liability. Unlike a skydiving instructing business, right? They probably run some of the highest risk in what they do professionally. They're jumping out of planes a mile in the sky with a human life attached to their chest. So whether the net profit is there or whether they own personal assets that need protecting, some industries might incorporate right out the gate solely because of the risk and liability factor. For real estate professionals, for wealth managers, for tax advisors, for physicians, we need to make sure that we have the asset protection benefit, the net profit is there, and we also need to double check on the levels of risk and liability. If you check yes to all three of those boxes, proceeding with incorporating is, to me, a no-brainer. It is something that is absolutely a conversation to be had, but it is not right for everyone. We need to dial in your specific and unique scenario first before suggesting to take that next step to incorporate. Like I said, just because a friend or a family member incorporated doesn't mean that you should go online to LegalZoom and start your own entity. You need to understand some of the obligations contractually and financial obligations that you tie yourself to with the state of California and with the federal government by incorporating. For instance, every year, whether you're an LLC, an S Corp, or a C Corporation, the day that you incorporate, you tie yourself into a financial obligation with the state of California to owe the Franchise Tax Board $800 each year that you file your return. I call it the parking ticket for parking your business in the wonderful state of California. It's $800 minimum, and California has the highest filing fee in the United States. So once again, we need to understand some of the obligations that you tie yourself into when you do take that next step to incorporate. If we decide that incorporating is right for you, it's not a matter of just meeting with your accountant once a year to handle everything. Now that you have this formal entity structure in place, you need to meet with your accountant at least 2 times a year. Once during tax season to file the returns, obviously, and then once before the end of your calendar year or fiscal year, depending on if you have a fiscal year end or a calendar year end, you need to meet with your accountant to actually dial in year-end planning. Remember that tax season, the year is already ended, right? So you should already know what your tax situation is prior to actually filing your return. Nobody likes surprises when they file their returns. I know that when my clients are, when they choose not to do year-end planning, they come in to file their returns, maybe they were too busy towards the end of the year to come in and meet with us prior to the end of the calendar year. And so they didn't have a plan in place. I know that they don't normally enjoy the results of not planning ahead. Failing to plan is ultimately planning to fail. And that phrase goes hand in hand with what we do in the tax industry. We need to put a plan in place in October, November, and December so that we already know what your tax return is going to look like prior to filing. And that way, when we meet during tax season, it's just plugging numbers in, figuring out if there were any final year-end deductions in maybe December after we had met to do year-end planning, and then also figuring out any additional contributions to deferred retirement accounts that might help further reduce liability in the filing season. During the pandemic years, we saw a lot of changes to the Internal Revenue Code, and we are still waiting kind of in limbo right now for 2022's Internal Revenue Code. I thought personally that we'd have a bill in place last October. But here we are in May, still waiting for the 2022 Internal Revenue Code to be finalized. We have an idea of what potentially will be changing, but nothing has been set in stone. There's a lot of bipartisan agreement, at the federal level where they're not, or lack of bipartisan agreement at the federal level where they're just not agreeing on things these days. Changing the capital gain tax rates, changing Section 1031 of the Internal Revenue Code, which is the 1031 exchange, changing certain income brackets, getting rid of bonus depreciation. These are all things that are still in discussion at the federal and state levels. And the state of California usually follows suit. As soon as the federal government releases their Internal Revenue Code, California then chooses what to conform to. They don't normally just conform to everything that's changed on the federal level. They kind of dial in what they would like to accept and what they would like to deny the taxpayers here in the wonderful state of California. So we're still waiting to hear the final verdict on a lot of that. But as far as the power of incorporating is concerned, we haven't really heard very much conversation at the government level, at the IRS level, about what they would change for self-employed individuals who are incorporated as LLCs or S corporations. I do know one thing that probably 99% chance it will pass is the change to the C corporation tax rate. Unlike the LLC and the S Corp that are flow-through entities, meaning that the LLC and the S Corporation don't actually pay any federal corporate or entity tax. All of the income passes through to the individual owner, and you pay the income tax, federal and state income tax on the personal return. The C Corporation doesn't play that game. The C Corporation actually has a corporate tax rate as well as an individual tax rate on whatever you've paid yourself as a dividend or a payroll from the C Corporation. The federal government will be changing the C corporation tax rate and bumping it back up to from 21%, which it currently sits at right now, up to about 27% or 28%, depending on where the dust lands, which is still a heck of a lot better than what it was prior to 2018, which was 35%. So they're bumping it back up to about a halfway point between the old Internal Revenue Code and the new Internal Revenue Code, making the C corporation tax rate about 27%. At the end of the day, that is still a pretty high tax rate for C corporations. And when we talk about C Corps, those are usually the eBays, the Starbucks, the Amazons, the Teslas of the world that are filing as C corporations. Some of you may enjoy the benefits of filing as a C corporation, but it really all depends on your individual scenario. Not everyone in the real estate industry will enjoy a benefit under a C corporation, but there are a few individuals in today's webinar that may actually elect C corporation status over S corporation status. But you have to have this conversation, not very much of a long-winded conversation with your tax advisor, but have the conversation with your tax professional before choosing between the S corporation and the C corporation. It may make more sense to file as a full-blown C corporation. Most of the requirements of a C corporation land around the amount of shareholders of the business. For instance, if you have over 100 shareholders of your corporation, you're actually required to file as a C corporation. If you tend to have over $10 million in gross revenue, normally you file as a C corporation with some subsidiary entities attached to that entity. I don't know if there's anybody in today's webinar that meets those requirements. I doubt so today. But if you are not in that bracket or meeting those qualifications, normally the S corporation or the LLC would be the better overall option for you. LLCs, just to kind of end this conversation real quick, LLCs provide no tax benefit to you individually. They save you absolutely nothing in tax. LLCs. They do exactly what their name entails. They limit liability. Whereas the S corporation, the subchapter S corporation, that will actually allow you to reduce by upwards of 60% the amount of self-employment tax that you pay on a year-to-year basis. I don't have enough time today to go over all of the scenarios, but through our free consultations, our senior advisors would be more than happy to dial in your specific scenario to see which entity would be right for you. And we'll be very transparent as to whether or not incorporating is right or not right for you. We do not want to overpromise and underdeliver. So if we take a look at the numbers and it just doesn't make sense today, as of the present, to incorporate you, we'll say, well, let's have this conversation next year. Maybe you'll be hitting stride and hitting that net revenue amount of about 45 to 50 grand that then warrants the benefit or warrants the moving forward with incorporating as either an LLC or an S corporation. But we have to have this in-depth conversation, this interview process with you before we suggest to take that next step to incorporate. I have a lot of clients, and in fact, I'm okay with giving you a percentage of clients that do actually end up incorporating. Most of my realtor clients who are netting, not gross commission, but netting after expenses are taken into account, if they're netting $45,000 to $50,000 or more per year, about 98 to 99% of those realtors do take the next step to incorporate themselves as subchapter S corporations, because they want the benefit of sheltering their income, not only from a tax perspective, but also creating a lower DIF score, is what we call it in the tax industry. That DIF score is the percentage of audit for you as a business owner. As a sole proprietor, you have close to a 70 to 75% chance of audit each year as a single member, just sole proprietorship, filing a Form Schedule C. Under a corporation, you have 1 in 350 chance, a 1 in 350 chance of being audited under a corporation. It's not a magical potion that is, consumed as an entity filer, but it is the fact that you are a small fish in a very large pond as an incorporated entity. So some individuals incorporate solely for that benefit. I don't push people to incorporate because of this benefit. I want them to meet all of the qualifications and get all of the benefits by incorporating. But that happens to be one benefit that you receive by filing as an entity structure like an S corporation or a C corp. The other benefit for self-employed real estate professionals is the reduction of self-employment tax that you pay on a year-to-year basis. For instance, a subchapter S corporation can reduce your self-employment tax by upwards of 60%, not 6%, by upwards of 60%. Well, self-employment tax alone is 15.3% of whatever your self-employed profit is. So as you can imagine, the more you make, the more an incorporated entity would save you. And once again, we need to dial in these numbers for each of you individually to figure out if it's worth it to incorporate for you specifically, not based on what your coworkers or your family members or your friends are doing for their self-employed businesses. All right, let me go ahead and click the next slide here. For some reason, it exited out there. Okay. So obviously with real estate investing, aside from incorporating, once you've decided whether or not an LLC is right for your rental property, for instance, you also want to know about ways to shelter your income further than just the normal additions to your property, you know, the remodeling of a kitchen or the gutting of a bathroom or new irrigation systems or solar panel improvements. One thing that I've seen to become incredibly popular over the last 2 years is something called cost segregation. Now, some of you may have heard of this term before, but some of you may not. And it's surprising, to be real honest with you, how many real estate professionals have not heard about cost segregation. Cost segregation has been around for a very long time. Some of you may have heard of bonus depreciation, that term before, which bonus depreciation and cost segregation, they go hand in hand in more than just a couple ways. Cost segregation is the ability for a rental investor like yourselves, let's say you own a couple rental investments, it's the ability for you to reach into future years and capture future year depreciation and accelerate it as a dollar for dollar write-off in the current tax year. So imagine that you have low debt on a rental investment, or you have a client who's getting ready to purchase a rental property and they need additional write-offs. Let's say they bought the property outright cash. They don't have the mortgage interest deduction. They have small depreciation write-offs and property taxes and improvements. But at the end of the day, they're still cash flowing pretty nicely on this investment. And they're asking their tax advisor and their real estate professionals, what can I do further, deduction-wise to decrease my cash flow and save more tax so I can buy more property? Cost segregation it might be the key benefit for them in this current tax year. It will allow this real estate investor, once again, to reach into future years and capture future year depreciation write-offs in the current tax year. I've seen clients just yesterday, actually, my first client yesterday, they did a cost seg analysis with a third-party vendor, because it has to be a third-party vendor doing the analysis. We use Incentive out of Pasadena. And this election for my client yesterday, my 10 a.m. appointment, allowed them to accelerate $506,000 of future depreciation write-offs, all in 2021. Meaning that through this analysis, they were able to capture this phantom expense, this bonus depreciation write-off of $506,000 all in 1 year. Now, some of you veteran real estate investors are thinking, well, depreciation is great, but when you sell the property, if you ever sell the property, don't you have to recapture the depreciation and pay tax on it? Yes, that's absolutely the case. But most of my real estate professionals don't ever plan on outright selling their properties. If anything, they'll refinance the properties, pull out equity to buy more property, or they will exchange these properties for other properties, like kind exchange the property. Maybe going from one Pasadena property into 10 rental investments elsewhere in the US, or maybe a warehouse here in California for a 10-unit building in Arcadia. There are a number of ways that you can mix and match properties in a 1031 exchange that will allow you to defer the recaptured depreciation tax as well as the capital gain tax. Cost segregation is not a bad thing. Sure, it does increase the overall depreciation write-off, which if you ever sell the property would have to be recaptured and you pay tax on that. But once again, if you're like me and you never plan on selling property, you just plan on exchanging it or tapping into equity to buy more property, I'm looking for the write-off, the immediate benefit right now. And like I said, this example just yesterday morning was one of probably 50 to 60 cost segregation filings I've done over, since January of 2022, where it allowed for massive accelerated write-offs to offset rental property cash flow. So if you haven't heard of this term, you can look it up online, or you can sign up for a free consultation. We can dial in some of the defining, the definitive descriptions or what am I trying to say, or the breakdown of what cost segregation would do for you. And I believe most cost seg companies will do the upfront analysis for free. And then if you move forward with the cost seg analysis, there will be fees on the back end. Like I mentioned, we use Incentive out of Pasadena. There are a number of cost segregation companies in California that you can use. That just happens to be our go-to referral source that we refer our clients to. But great way to create more overall write-offs for you as a real estate investor. The people who truly benefit from this are not only the real estate rental investors, but the real estate professionals who practice what they preach. My real estate professional clients who are earning commission income selling properties, but also investing their money into rental properties, whether they be short-term Airbnb or long-term 12-month, 24-month lease rental properties. These individuals are the ones that get to take the greatest benefit from real estate related loss deductions. So imagine this, imagine that you're a real estate professional making 500 grand in overall self-employed income, and you have very low overhead, and you've already maxed out your deferred comp plans. You've already bought the vehicle and accelerated the depreciation on the business vehicle. You've upgraded your computer equipment, did the in-home office deduction, and you've kind of run out of options, and you're still showing pretty sizable net profit. Imagine going and going to Incen Tax, for instance, moving forward with a cost segregation analysis, and they figure that they can accelerate $400,000 to $500,000 of future depreciation. All of a sudden, your $500,000 profit as a real estate professional is now offset dollar for dollar by a $400,000 to $500,000 loss through some of your real estate investment rental properties. Now, all of a sudden, your federal and state income tax is zero, or very, very low, all because you made the proper elections prior to the filing deadline of that individual tax return. In fact, the cost segregation analysis doesn't even have to be done in 2021. You can actually do the cost seg analysis now for the 2021 tax year. And there are carryback rules that you can make for 2021. So if you're looking at your 2021 tax return and thinking, man, I paid way too much tax in 2021, maybe this is an option for you to go back and correct or amend this tax return and carry back some of these deductions to get some of that money back. These are all great conversations to have with your tax advisor. And I'll be real honest with you, full transparency here. Every accountant is cut from a different cloth, so to speak. Not all accountants understand how cost segregation works. I know that not all accountants understand how incorporating works and how to operate an LLC or an S Corp or a C corporation. So please work with tax advisors who understand these very unique parts of the Internal Revenue Code. Bonus depreciation is not going away in 2022 or 2023, but the federal government is talking about dropping the 100% bonus depreciation through cost segregation down to 80%, which is still a heck of a deal. Even though you're losing potentially 20% moving forward into future years, I mean, think about it. Accelerating 80% out of the 100% bonus depreciation is still a massive overall adjustment to your taxable income. So keep this in mind, that doing it now might allow you to benefit from the 100% deduction amount, the bonus depreciation amount, versus having to play by the new rules, which are still great rules, by the way, at 80% versus the 100%. So keep that in mind. Timing is everything nowadays. Now, for some of you, you might think, well, I don't really want to incorporate my business. I already have a living trust in place, or I have, a great insurance policy that is there to protect me in case anything happens. Just understand that when you open up each one of these doors that you see in front of you, you are provided a completely separate benefit. An insurance policy does not protect your assets like an LLC or an incorporated entity would. An incorporated entity does not give you the same benefit that an insurance policy will provide. And neither the insurance policy or the incorporated entity will provide you the same benefit as a living trust. In fact, the LLC protects you from potential litigation in the present. So in case you're ever sued by a tenant or by a client, the LLC and the entity structures will help separate your business and your personal assets in the present while you are still alive and doing well. A living trust will protect your assets in death. So one major life event has to happen in order for a trust or an estate to kick in and provide a legal benefit for you. A trust and an estate will not provide you any income tax benefit. It only protects you from probate in whatever state you live in and own assets in. So once again, an LLC or an incorporated entity versus a trust, two completely separate benefits that you are provided or if you walk through either one of those doors. The most important thing for us to have as business owners and investors is insurance. Insurance provides you a dollar benefit payout in case an unforeseen event happens. Not all of us have insurance, but all of us should have insurance. We have health insurance in case we get sick to pay for some of our medical bills. We have car insurance in case we're in a car accident and we need to repair our cars and the car that we crashed into. We have homeowners insurance, earthquake insurance, hazard insurance, liability insurance, malpractice insurance. We have insurance and it's there and in place to pay out settlements in case an unforeseen event happens. So should you have all three of these things in place? Absolutely for insurance, maybe not the entity just yet. That's where the conversation with your tax advisor or legal advisor comes into play. Should we all have living trusts and estates in place? Well, it depends. If you don't own any personal assets, if you don't own the home that you live in, if you have no inheritance, if you have no retirement accounts, if you have no personal assets, what would you need to protect from probate at that point? But as you start to have families and have children and acquire assets, yes, absolutely. And you're not getting the benefit personally to yourself for the trust. The trust is for legacy protection. It's to protect your assets for your loved ones. So eventually, as we grow wealth and we build our real estate portfolios and our brokerage account portfolios, and we develop new avenues for wealth development and new revenue streams for ourselves, yes, we want all three of these doors opened for us as investors and people who want to obtain and retain wealth. Right? Because I figure, and I always tell my clients this, and I think it'll make sense to everyone in today's webinar, that as you grow wealth, the most important concept or approach that you need to take is, okay, as I grow wealth, how do I keep most of it, right? How do I protect it from potential probate issues or from potential litigation, or in case, heaven forbid, an unforeseen event happens? Well, this is how you would protect all of your wealth moving forward. And for me, it's all about legacy. I have a 3-year-old son. I have a 10-month-old daughter now, and I have my loving wife. I want to make sure that all of my assets are protected for my family in case, heaven forbid, anything happens to me, or to protect it for me in case anything happens to my family. These are very important conversations, kind of some dark conversations to have with your legal advisors and estate planners and tax advisors, but man, they sure are important. Do not wait till end of life to do planning. Start as early as possible to make sure that you're protected as you continue to build wealth for you and your family. Let's talk really quickly about the potential changes to the 1031 exchange part of the Internal Revenue Code. Once again, 2022's tax bill has not been finalized yet. I've heard from a number of sources that this conversation has been tabled, meaning that they are not planning to change anything in Section 1031 of the Internal Revenue Code. But I am very much a believer that until it is set in stone, I do not listen to anything. Any advisors, I don't listen to anything that I read online or any news or media outlets about what has changed until it is set in stone in the Internal Revenue Code. I've learned the hard way over almost 2 decades of working in the tax industry that until it is set in stone, it does not exist. Until it is in writing, it does not exist. So my head is on a swivel. I am very much anticipating that there will be major changes to the Internal Revenue Code for 2022, but we do not have a final bill in our hands yet. Section 1031 is on the docket and has been a conversation of something that will change, meaning that as it stands today, in the present, we can exchange property, real, tangible property. So multi-unit buildings, single-family homes, warehouses, developed land and some undeveloped land, depending on how undeveloped it is, can be exchanged for other like-kind assets. No longer can you exchange equipment for equipment. No longer can you exchange art collections for art collections or car collections for car collections. You can only exchange real property, so rental investments, for other like-kind assets. And that change happened back in 2018, but the potential change on the horizon is not a change to the assets being exchanged, but it's a change or alteration to the amount of money that you can defer in taxable income. Right now, there is no limit to what you can exchange. If you have a $100 million investment, real estate investment, you can exchange it for a like-kind asset of $100 million or more. If you have a $1 million single family home in Burbank, you can exchange it right now for $1 million+ in property elsewhere in the US. Or you can do a down leg exchange. You go from $1 million into a $500,000 property, maybe accessing some cash to pay off a primary residence or student loan debt or credit card debt. You can do an up leg exchange where you go from a $500,000 property into $1 million property and you're acquiring more debt in the deal. There are up leg, down leg, and like kind exchanges, and there is no limit to the amount that you can exchange or access. The potential change on the horizon is a limit to $500,000 per taxpayer, meaning that if you bought a home for $500,000 and now it's worth $2 million, if this part of the Internal Revenue Code changes, you will only be allowed $500,000 per taxpayer in deferral of gain. So if you're married filing joint, it would be $1 million. If you're a single filer, it's only a $500,000 exclusion. So if you bought that property for 500 grand, it's worth 2 million bucks, and you're married filing joint, you can exchange $1 million of the gain, but on that $500,000 overage, plus whatever the recaptured depreciation is, you would actually have to pay income tax on that. Now, it doesn't make sense to me as a tax advisor, knowing how this part of the Internal Revenue Code works. How is the government going to calculate the portion of tax and recaptured depreciation amount on the $500,000 overage? It seems like they are significantly overcomplicating a part of the code that has been around since the early 1900s. I mean, some of these parts of the Internal Revenue Code that are set to change have been around for over 100 years. I think Section 1031 has been around since 1921. Some of the real estate professional parts of the Internal Revenue Code been around since the early 60s. And the new administration, Biden administration, hasn't dialed in all of these changes just yet, but there are some major changes on the horizon. And I think there's a lot of disagreement right now at the government level where they haven't really come up with a bipartisan agreement on any of it so far. So until it's set in stone, I don't want anybody making any rash decisions with their investments solely based on speculation. We are speculating right now what will change. I do know a couple statistics about the exchange industry. Number one, the 1031 exchange industry creates over 600,000 plus jobs globally across the world. I mean, not only here in the US, but globally. It creates over 40 or $50 billion in tax revenue collected by the federal government. And it also makes up for 16% of all United States real estate transactions. So to limit this kind of gain through the Section 1031, it wouldn't be killing an industry, but it would be altering an industry that generates the federal, a lot of revenue for the federal government and provides a lot of employment across the US. And what I foresee is that a lot of people who have owned their properties for a very long time, they will decide not to exchange their properties if this bill or this part of the bill is passed. I'm really hoping that the whispers in my industry about it being tabled, about this not going through and not being on the docket anymore, I'm really hoping that those whispers are true. But once again, until it's actually in writing, until it's set in stone, I can't really believe anything these days. So once we have that bill in our hands, I'll be back to give you a full-blown update on the 2022 Internal Revenue Code changes. Another thing that is potentially changing that kind of involves the Section 1031 of the Internal Revenue Code part that we just discussed is the change to long-term capital gain tax. So let me kind of tie these two in. If you are now taxed on gain over $500,000 to $1 million, that would be capital gain in theory, right? So every dollar above that 500 grand to $1 million exclusion would be long-term capital gain plus recaptured depreciation. Well, the federal government is also talking in 2022 and 2023 and moving forward, changing the long-term capital gain tax rate to 39.6% for every dollar of capital gain that puts you as a single individual over $500,000 in household income, taxable income, or married filing joint over $1 million in taxable income. So let me give you an example. If I am a married filing joint couple and I 1031 exchange a property, and let's say my gain on the exchange is over $1 million. So let's say I have $500,000 in capital gain now that becomes taxable to me individually, married filing joint. Well, let's say my wife and I make $600,000 of overall household income, plus the $500,000 capital gain that we have to add on from the change to Section 1031. That puts us well above $1 million in overall household income. Every dollar in capital gain above $1 million in household income is no longer subject to the lower long-term capital gain rate. It is now subject to 39.6% long-term capital gain tax, plus recaptured depreciation tax, plus the state of California capital gain tax of roughly 10%. Now, all of a sudden, we're paying 55+% capital gain tax on every dollar that we made above and beyond the set, the changed exclusion, which is you losing a lot of money in your retirement assets. It just doesn't make sense to me whatsoever. You can see how complicated the potential changes on the horizon are and what they would do to you individually from an income tax perspective. Now, I understand that California and New York investors and real estate professionals, we are unique. We sell higher valued properties. We tend to make larger amounts of income because cost of living here in California and states like New York and even Hawaii, cost of living tends to be higher. So we make more than the other 47 states across the US. The other 47 states might not be impacted as much as California and New York and Hawaii would be impacted by these changes. But nonetheless, California and New York also supply the federal government with a greater chunk of the internal revenue tax collected on a year-to-year basis. So if you tax Californians and New Yorkers and Hawaiians more, what's going to happen? Well, what's going to happen is what we've been seeing happening over the past decade, which is mass exodus from the state of California. You tax individuals for working hard and for making good investments, they're going to leave the state of California. No joke, and this is not a statistic that I'm overestimating. On the low end, 30% of my personal clients have picked up and moved out of the state of California over the past 2 years. That is on the low end. And I've actually gone through my client roster. They're still all my clients because I can do taxes in all 50 states. But I've seen a lot of my clients who I've been used to meeting in person over the past 17 years that I've worked here. Now we do things remotely because they live in other states. Because of the potential changes on the state side, income tax wise. They still do business here in the state of California, but not as California residents. And sure, they still pay a little bit of California income tax, but what happens when you move out of the state of California and still operate business in the state of California is you pay a non-resident tax to the state of California, which is much less, almost half of what you pay as a full-year resident if you continued living here in the state of California and operating business in the state of California. So a lot of major changes. The pandemic was kind of the fueling to the fire of this, but I've been seeing the mass exodus over the past decade simply because California is the highest tax state in the US, and they are not very business friendly. In this state from a tax perspective. I don't want to argue about politics or anything. It's just, it is what it is. We pay for the sunshine, we pay for the water, we pay for the oxygen that we breathe. We pay for everything here in the state of California, and we seem to still be running out of money left and right. So just be aware that there are, for us California investors and New York investors and Hawaii investors, it's probably more important for us to put a plan in place more than the other 47 states, because the more we can shelter, the more we save. If our tax rate is 45 to 50+% of our taxable income, every dollar that we are able to come up with an additional write-off, an additional tax sheltering expense, it saves us 45 to 50 cents on the dollar. That's a 45 to 50% return on everything you plug your money into that is a potential write-off, including that great cost segregation deduction that we discussed briefly today. So obviously we covered a lot. I'm sure your heads are spinning, your eyes are rolling back in the back of your head. The tax topic isn't exactly the sexiest topic to discuss, but man, it sure is important. Life, death, and taxes. I can tell you that, whether we're alive and doing well or 6 feet under, the federal government is going to expect us to pay our fair share of the piece of the pie that we made for ourselves over our lifetime. And if not for you, do tax planning for your legacy, right? For your children, for your spouses, for your loved ones. Shoot, if you want to donate everything in death to a 501c3, do the planning for charitable reasons. Doesn't matter what you're doing, just put a plan in place to pay your obligation in tax to the federal government and the state agencies, and not a penny more than your obligated amount. Keep that in mind, okay? So I'll leave this screen up while we do a little bit of Q&A here. This is the way to get in contact with my office for the free consultation. Make sure to send over 2 years of tax returns so we can review and analyze what you filed in past years, especially 2021, if you've already filed for 2021. And let us check for any possible audit triggers on the return, or if there is a benefit to going back and correcting or amending those returns. Let's discuss that option as well and maybe get some money back for overpaid tax in 2021 or 2020 or 2019. We can go back 3 years to apply for any refunds. If 2018 was on extension, then we have until October 15th of this year to correct 2018. 2019 and 20 and 2021 can obviously be corrected, but let's go ahead and analyze to see if there's any money that was left on the table. Okay, so I'm good to go for Q&A if we're ready to rock and roll with that.
my God, there is so many questions in my head right now. I mean, Tony always gives tons of information though, but there is quite a lot of questions in the chat box. I think the first question I got was from Jessica. I think she's asking what's incorporate different from these entity. I guess her question is basically asking there's different type of incorporation, INC. So I think that's her question. I might be wrong, but then I think I asked her that question myself. So I think she just wanted to know what incorporation is.
So incorporation is when you take your sole, like for instance, if I'm working as Tony Watson under my social security number, I am just working as what's called a sole proprietorship. It's just me working under my personal name and my personal social security number. If I want to take my self-employed business and separate it for liability protection purposes from me personally, because I carry my own level of risk and liability individually, personally as an individual. And if I want to separate my business from my personal social security number, I would incorporate my business and assign my business its own identification number as an LLC, a limited liability company, as a subchapter S corporation, or as a C corporation. And that allows me to assign my business its own social security number, except it's not a social, it's called an FEIN, Federal Employer Identification Number. And now my business is like its own human being, it's its own entity. And that way I file a tax return separately from my individual return for my business. And then I allow the profit and the expenses to flow through or pass through to me individually. And if somebody is suing my business, they're not suing me personally. If somebody's suing me personally, they're not suing my business. So asset separation equals asset protection and vice versa. So an incorporated entity would be LLC, S Corp, C Corp, maybe even a limited partnership or a limited liability partnership. Some people call it a limited family partnership. There are different terms that you can use. But from a legal perspective, I have to let you know, I'm not an attorney. So if you have any legal questions, I'm not going to be able to answer those. Even though I might know the answer, my license just doesn't allow me to give legal advice. But from a tax perspective, really the only entity that can save you income tax is the subchapter S corporation. But it's not going to save you federal or state income tax. It's only going to reduce your self-employment tax by upwards of 60%. And once again, I don't have enough time to go over every single scenario in the book, but I want you to understand that it is going to be different between an LLC, S Corp, and a C corporation to figure out which one is going to actually save you tax versus what is best for liability protection as a property owner or just a long-term or a short-term real estate investor.
Okay, then the next question I have is actually from Joanna. She's asking, do you also help foreigners set up how to incorporate if they want to invest in the US, so foreigners?
So we do have a international tax attorney, not here in our building, but we have a great referral for you who can set up the proper entities for foreign investors. We can handle anything US income tax return related. We do not file foreign tax returns, but if your investors need help filing here in the US, absolutely. We would need, and we have senior advisors here on staff that can assist with that. That is not really my specialty, but we do have people here at Robert Hall who can assist with that. It does involve quite a bit of application on the return. We have to apply for an identification number with an SS7, I believe it's called. If they don't already have a social security number, we have to apply for an ITIN or actually go through the process of applying for a social security number. And then we can start the process for incorporating, and then they can move money from their foreign bank account here to the US and start investing in real estate related investments after all of those dominoes have fallen. So we do, yes, to answer your question, we can help and assist with all of that.
And then Mario has the question, have you heard of family limited partnership? Are they better than LLC for legal protection though?
So once again, I'm not an attorney, so that would be more for our attorneys here at Robert Hall. As far as the legal protection is concerned, I know that there is different asset protection benefit you get between the limited family partnership and the LLC. I can't really speak on that. And to be real honest with you, things change each year. So my license doesn't allow me to give legal advice, I would have to connect you with Michelle Maddie, who's here in our building. She is our estate and trust planning attorney. She incorporates limited family partnerships. She incorporates family trusts, irrevocable, revocable trusts, estates, limited liability companies, so on and so forth. So I can absolutely recommend you to Michelle Maddie, and she can assist with all of those questions.
Well, you basically answered Mario's next question. Can you recommend someone to do a living trust?
Yes, absolutely. Her name is Michelle Maddie. Let me give you her. Her contact info. I'm going to pull it up here on my screen really quick. Maddie, sorry. She's actually on the first floor of our building, and her phone number is 818. Actually, you know what? I'll type it in the chat box. Michelle Maddie. Her number is 818-551-7955. And her business is Michelle E. Maddie Law Offices. Law offices on Michelle Maddie. I've been working with her for every year that I've worked at Robert Hall. Bob Hall has been working with her for 30 plus years. She, in my opinion, is one of the best in the business. So definitely reach out to her if you have any of those legal questions or concerns.
And then the next question I have from Joanna, and what about Light LLC? The max amount in 1031 exchange might be changed?
That is correct. So remember the 1031 exchange, if they are changing the overall deferral of gain to the $500,000 for single individuals, $1 million for married filing joint, it will be across all platforms. So it doesn't matter if you're an LLC or an S Corp or a C corporation, the tax rate would be the same. Because remember, the LLCs are pass-through entities. So individually, whatever that overage and gain is that is not able to be deferred on the tax side, that would be taxable to you individually at the long-term capital gain rates, whatever those end up being under the new tax bill. So the LLC and the S Corp and the C corporation, if they do own property and you are trying to exchange through those entities, it would still be playing by the same rules, potential changes to Section 1031, which would limit it to $500,000 and $1 million. Once again, we don't have any of that in writing right now, so it's all speculation still. We have to wait for that to be actually set in stone and in writing in the Internal Revenue Code to then start advising or to proceed, with what you're able to do, selling your property, exchanging your property, pulling out equity and buying more property. That way, you're going to see a lot of that done in future years, where if this does go into effect, people are not going to be exchanging properties, especially properties that they've owned for 30, 40 years. I mean, what's the point in doing that if you're going to pay all of this capital gain tax, which is less revenue for the federal government? It's like they're cutting their nose off to spite their face. It just is a very, very strange overall potential change, in my opinion.
And the next question we have from Christine. I think I can answer that question myself too. How long does the incorporation process takes for the S corporation?
So right now, California is quoting about 5 to 8 weeks. I know that California, for a while during the pandemic, they closed down their expedited filing fee department, meaning that you could have it up and running in 7 to 10 business days. Right now, on average, it's about 5 to 8 weeks. I've seen entities come back in under 4 weeks over the last couple of weeks, though. So it really all depends. If you pay the expedite fee, it can take probably about 7 to 10 business days. So about 2 weeks, 2.5 weeks, because I know that they've opened that back up. A normal processing time is anywhere from, I'd say, more like 4 to 6 weeks now. At one point, it was 5 to 8 weeks during the pandemic. So I'd say 4 to 6 weeks before the actual articles get processed with Sacramento, with the Secretary of State.
Yeah, the last company I I assist one of my clients. It literally took almost 2.5 months. So.
Wow. So yeah, 8.5. I mean, yeah, that was common during the pandemic years. So they might still be taking longer to process. I know for a fact that the state agencies and the federal agencies, they've lost a lot of employees. I know that we've heard that the IRS and the Franchise Tax Board, they're hiring a lot of people. And in our minds, you're thinking, wow, they're hiring on top of all of the employees that they already have. Just understand this, that during the pandemic, the IRS lost a lot of employees. So they are rehiring just to replenish the seats they lost during the pandemic. They're not hiring additional employees on top of what they had prior to the pandemic. I also know that the IRS intentionally destroyed over 30 million tax returns that were paper filed during the pandemic. You can find the article in any accounting journal that was posted over the last week, where the government actually intentionally destroyed 30 million paper filings that were filed over the past year, which is absolutely insane. I don't know what the result of that is going to be, but there are a lot of changes at the federal and the state agency levels. And I am sure that simply because of manpower issues, where they don't have enough employees, that it is taking longer to process paperwork for incorporating, for paper filing, even for processing correspondence with the state of California and the federal government is taking 2 to 5 months. I have amended returns in play from 2019 that still haven't been processed, that are supposed to issue refunds. And the federal government's going to pay anywhere from 4 to 5% interest on refund money that they still owe the taxpayer. But at the end of the day, it could be another year before that money gets sent out. We live in a very strange time right now. And we've had to all adopt a certain level of patience with our financial advisors, with our tax advisors, with our bankers, with our lenders, with escrow, with the federal government. So just make sure that you don't delay any further than you necessarily have to. You want to file as soon as possible if you know incorporating is the right thing for you after a conversation with a tax advisor, or if you automatically know that you've hit all of those points in today's webinar and you want to start the process of incorporating, do it yesterday. Do it as quickly as possible to get that in the pipeline so that it processes as quickly as possible.
And then the next question is from Mindy. She has a client that inherited property late last year and is located in Orange County. Would you advise client to sell and perform a 1031 exchange? Client doesn't live in Southern California, but does have rental property in Northern California as well.
So in this scenario that you're discussing, when you say they inherited the property, my assumption is that a family member has passed away and this family member has left the property for your client. And I personally don't believe, as long as your client was not on title of the property prior to the individual passing away and leaving it as the inherited property, your client receives something called a stepped up basis benefit, meaning that whatever the property was valued at the time of death of the loved one that passed away, that now becomes your client's basis in the property. So let's say that the parent or the loved one who passed away, let's say they bought the property for 200 grand. Now it's worth $1.5 million. The individual passes away. Your client inherits the property at a $1.5 million fair market value price. And let's say that now the property is worth $1.9 million. Well, if they outright sell the property, they don't pay tax on $1.7 million because of the parent's basis of 200 grand. They only pay capital gain tax on whatever the difference is between the fair market value at the time of death and the sale price of 1.9 million, minus any closing costs, minus any improvements that they made to the property after the date of death of the loved one. So I wouldn't suggest doing a 1031 exchange on that property. I would suggest outright selling it, sitting on the cash and waiting for the market to correct, because we know that there's a correction in the future sometime. But why exchange when their gain overall is so little? The main benefit here for inherited property is that they get the big stepped up basis on the property, and they're only paying a very, very small capital gain tax on the dollar amount above and beyond what the fair market value of the property was at the time of death. So it really all depends. I would have to map out those numbers to figure out if an exchange was worth it. Now, if they inherited the property at 1.5 million and now it's selling for 2.5 million, and they're looking at $1 million of gain in a matter of 6 to 8 months, different story. So it really all depends on how much that gain or appreciation of the property was after the date of death or after they inherited the property, and how much tax liability they would incur on that. If it's a small overall capital gain tax, I would suggest paying it, sitting on the cash and waiting till something becomes more available. Remember that in an exchange, you have 45 days to identify up to 3 properties, and including the 45 days, you have 180 days to exchange it into another property. So it kind of locks you in to reinvesting that property. Now, in this scenario, they could pay for the exchange, and at the end of the 180 days, if they decide that they don't want to exchange into any properties, they end up paying the capital gain tax anyway. So they could enter into the exchange knowing full well that the capital gain tax is pretty low, and that gives them 180 days to find something. If they don't find anything, they pay the tax on it. Not an issue, right? So there are a couple options for your client there. And I think that if the best advice, Mindy, that you could give them is to talk with their tax advisors about what options there are for them. Either way, tax advisors are not deal killers for you as the self-employed real estate professional. Whether it exchanges or whether it sells outright, you still get paid. There's still escrow on the property. So the best advice you can give them is what is going to keep the most money in their pocket at the end of the day, right? And if you have the ability to help them out with the property that they're exchanging into, man, double ending the deal, right? And getting paid in two places. And you are coaching them through a process that ends up keeping more of their wealth in their own bank accounts. So great overall scenario, but it really all depends on what the inherited value was, fair market value, the date of passing, and then what the property could eventually sell for, minus the closing costs and improvements or ready to sell costs.
Anyway, just to add to Minnie's question, she did say that the property is worth 1.4. I guess whoever owned the property before, they bought it for $300,000 in 1979.
Sure. So I mean, look at that overall capital gain. As long as your client was not on title of the property at the time of death, they inherit that property with a full stepped up basis at 1.4 million. If that's what the appraisal came back at, remember that in death, you need to have an appraisal as close to the date of death as possible to establish basis in the property for the inheriting party. There has to be an appraisal in place. That is what determines what that basis number is. And once again, so not on title, perfect. And if it's in a trust, that's fine. If it's in a living trust, I assume, then there is the full stepped up basis still on all of that. So there's a way to file that on the return. I wouldn't necessarily, if it's worth 1.4 at the time of death, what would the property sell for? Can you let me know what the property would potentially sell for? I think you're typing in things here. Living trust, perfect. So if it was worth 1.4 at the time of passing, what would it sell for today if they decided to sell the property? 1.4 million now. So what was it worth at the time of, as of the time of death, as of the date of death? 1.4? If 1.2. So, I mean, 200 grand in overall appreciated gain, minus the closing costs, minus the commissions paid out of escrow, minus all of that. I mean, you're looking at maybe $100,000 in overall capital gain, which depending on what bracket they're in could be, I don't know, 25 to 30 grand. And let's say on the high end, $40,000 in capital gain tax. Me personally, professionally and personally, I'd pay the 40 grand in tax. Take the cash out of escrow, sit on that, and be ready to pull the trigger on another property. We have improvement on perfect. So then you get to even write off the improvement. Hopefully you have 200 grand in closing costs and improvement to wipe that out. They sell it, they pay no income tax on it. Even better.
So the next question is with Christine. That's if I incorporate in the middle of the year, how would I report the income from first half of the year?
Yeah, so if you incorporate halfway through the year, unfortunately, the first part of the year would still need to be filed as a sole proprietorship. For the latter part of the year, you would file all the revenue under the incorporated entity. I mean, if you could get your payer to 1099 you, not to your personal name, but to your corporation, which technically they don't have to 1099 a corporation, but if they can file it all under the entity, then you can report it all under the entity, but the likelihood of that happening is very low. So unfortunately, the earlier that you can incorporate in the year, the better off you are, because then you'll have a full year of filing as an incorporated entity. That's why incorporating around January 1st is the best time to incorporate. I'm not going to say that incorporating right now wouldn't be a benefit, because now from here until the end of the year, you're going to capture all of your self-employed revenue under the incorporated entity. It's still going to save you more than it's costing you to file as an incorporated entity. So I think that there's really never a bad time to incorporate, unless you're talking about filing articles in December, right? Because then the articles won't even post until the following year. So I guess in the last like month to 2 months of the year, I wouldn't pull the trigger on incorporating at that point. I
think we're going with the last questions now, because I'm very interested in knowing the answer as well. This question is from Wendy Wong. 1031 exchange applied to foreign property, is like, for example, like Hong Kong, right?
That's correct. You can exchange foreign property for foreign property, U.S. property for U.S. property, but not U.S. for foreign property or foreign property for U.S. property. It can only be like kind in location as well. So foreign for foreign, U.S. for U.S., but not U.S. for foreign or foreign for U.S.
So let's say, just a question though, let's say foreign to foreign though, how would you report taxes on it though?
So once again, if you are a U.S. tax-paying citizen and you own a property in France and you want to exchange it for a rental investment in Italy, there would be escrow and a sale price and closing costs in France, and you'd pay tax in France. Depending on how you file in France, we don't do those foreign tax filings, but whatever tax you pay in France would be a foreign tax credit here in the United States. If you exchange the property, though, there is no tax, right? So depending on in France how the rules work in France, because I don't know French internal or French tax code, and I don't know Italian tax code. So whatever you would pay there, you'd pay there, and you get a foreign tax credit on the U.S. return. But you would exchange property there, and you'd report it as a 1031 tax deferred exchange here in the U.S. on your U.S. tax return with the foreign addresses. So there are foreign forms that you would file with your individual return showing the foreign transaction for 1031 exchange purposes.
Well, actually, we have one more question asked by Karen. Is step-up basis applied to all the property once inherited?
Everything except for deferred retirement accounts. So stepped up basis applies to stock accounts, like actual brokerage accounts that are not in retirement accounts. It applies to investment properties. It applies to other capital investments, art collections, car collections, syndication investments, anything that has not deferred tax. Remember, 401ks and IRAs, they have deferred the tax on the money that has been put into the retirement plans. And so you have never, that individual, that loved one has never paid tax on it. You cannot get a stepped up basis, or you don't receive a stepped up basis on retirement investments, only on capital assets, including stock transactions, so brokerage accounts and real estate type investments.
Thank you very much for all the question being asked, and thank you for Tony for all the excellent answer for it as well. I'm going to pass to Christine now.
Hello, thank you so much, Jonathan, for hosting our session today. And on behalf of everyone at the West San Gabriel Valley Realtors, we would love to thank Tony for being our wonderful guest speaker today. I've attended your class at least 3 times prior to this, and I always learn something new. So thank you so much for speaking and answer all the questions beyond our noon time. And we have more amazing and informative classes lined up for you guys. Our next Zoom and Learn will be held next Tuesday, May 17th at 11. We'll be having a panel of insurance experts speaking on the topics of insurance coverage and claim process. Be sure to check out our website under education schedule for the most up-to-date information on upcoming classes, and we hope to see you there. Until then, have a good day and goodbye.